Before we close, disclosures. This is computational analysis of publicly released government documents. It is not legal advice. No individual is accused of any crime. The 13 anonymized designations in this episode, Executive 1, Relationship Manager 1, Attorney 1, and the others, are reproduced exactly as they appear in the NYDFS consent order. This series does not attempt to identify the individuals behind those designations. An important legal distinction. The consent order is a regulatory settlement. It is not a judicial finding. The $150 million penalty was agreed to by Deutsche Bank. It was not the result of a trial or a contested factual determination. The bank neither admitted nor denied the findings as part of the settlement. All source documents referenced in this episode are publicly available at justice.gov/Epstein under Public Law 119-38. The NYDFS consent order is a public regulatory document. All processing tools are open source and ran locally. No data was uploaded to any cloud service. Wire extraction disclosure. Script 16's initial run produced 356,000 matches. After validation, 224 clean records. That is a 99.94% false positive rate on the initial extraction. The numbers in this episode reflect the validated output, not the raw extraction. Willful blindness phrase counts are linguistic frequency measurements across 229,000 documents. They are not accusations of wrongdoing. The pipeline counts. The consent order, written by regulators who examined these same records, provides the interpretive framework. This series does not identify victims. This project is independent of all institutions. If errors are found after publication, they will be disclosed in subsequent episodes. This slide is dedicated to defending the Constitution of the United States. The preamble to the Constitution establishes the foundational purpose of our system of government: to establish justice and ensure domestic tranquility. 3 core constitutional principles guide this series. First, due process. Every individual is presumed innocent until proven guilty. Allegations require evidence, not assumptions. Second, equal justice under law. The law must apply to all persons equally, regardless of wealth, status, or political connection. No one is above the law, and no one is beneath its protection. Third, transparency. Public records belong to the public. Meaningful accountability demands sunlight on sealed systems and institutional oversight. This series exists to uphold these constitutional principles, not to circumvent them. Every claim presented is grounded in publicly available government documents and regulatory filings. This is not about accusation. It is about accountability. Episode 4. Willful Blindness. The Deutsche Bank and $150 million. $150 million. On July 6, 2020, 331 days after Jeffrey Epstein died in federal custody, the New York Department of Financial Services assessed the largest penalty it had ever imposed on a bank for compliance failures related to a single client. This episode is about what those failures looked like, not in the regulator's summary, but in the 229,000 bank documents sitting in the DOJ corpus. The consent order covers 3 relationships: the Federal Bank of the Middle East, a correspondent banking failure involving $618 billion in transactions; Danske Bank Estonia, another correspondent banking failure involving $267 billion; and Jeffrey Epstein. This episode focuses on Section B, paragraphs 8 through 59. The full document is 37 pages, written in plain legal English, publicly available. It is the single most detailed public accounting of how a major financial institution processed a convicted sex offender's money for 5 years after his guilty plea. Everything in this episode is sourced from that document or from the pipeline's extraction of 229,000 Deutsche Bank records in the DOJ corpus. 229,400 bank documents. That is how many Deutsche Bank records the DOJ released in this corpus. Script 16, the bank document classifier, processed every one of them. It read each document, identified its type, and categorized it. 10 types total. 430 blank templates detected and suppressed. Empty forms that would generate phantom entities if processed further. This is the raw material, not the consent order summary of what happened, the original bank records themselves. 106,000 account statements, 50,000 wire confirmations, nearly 30,000 compliance emails, 12,000 Know You Customer forms, 2,700 enhanced due diligence reports, the documents a bank is required to produce for high-risk clients, 1,370 SAR narratives, suspicious activity reports filed with the Financial Crimes Enforcement Network. This is the anatomy of a 5-year banking relationship with a convicted sex offender. The account statements tell you what money moved. The wire confirmations tell you where it went. The compliance emails tell you who knew. And the EDD reports and SARs tell you what the bank did or did not do about it. August 19th, 2013. That is when Deutsche Bank opened accounts for Jeffrey Epstein, nearly 6 years after his guilty plea to 2 state prostitution charges in Florida. 4 years after the non-prosecution agreement with the Department of Justice became public through a civil suit. This was not a new client who slipped through a screening gap. Jeffrey Epstein was a convicted sex offender whose criminal history was publicly documented, widely reported, and known to the bank before onboarding began. The consent order makes this explicit. Paragraph 9 through paragraph 13 detail the press coverage and court proceedings that predated the relationship. Relationship Manager 1 joined Deutsche Bank in November 2012 from an institution identified in the consent order only as U.S. Bank 1. At that prior institution, they had managed Epstein's accounts. In the spring of 2013, Relationship Manager 1 and Epstein began discussions about establishing a relationship at Deutsche Bank. The consent order states this clearly. Paragraph 18. The relationship did not begin from a cold pitch. It was not the result of a marketing campaign or a referral network. A single private wealth manager moved from one bank to another and brought a convicted sex offender's accounts with them. Southern Trust Company, brokerage. Southern Financial LLC, brokerage. The Butterfly Trust, checking and money market, opened January 24th, 2014. Gratitude America, requested in January 2016, withdrawn when the ARRC ordered external due diligence that was never completed. More than 40 accounts total. The client was classified as high risk at onboarding. Deutsche Bank designated Epstein an honorary politically exposed person, an internal classification for clients whose connections to prominent political figures create elevated reputational risk. The bank knew who this was. They classified him accordingly, and they opened the accounts anyway. $606.9 million. Total inflows through a single account, Southern Financial LLC. This is not the total across all 40 accounts. This is one brokerage account at one bank. The consent order does not provide a total across all Epstein accounts at Deutsche Bank. 606.9 million is the figure it discloses for one. May 5th, 2013. Executive 1, identified in the consent order as co-head of Wealth Management Americas, sent a single internal email. It stated that the head of AML compliance and general counsel had approved the Epstein relationship. No reputational risk review required. The bank has no other record of this communication. That is a direct quote from paragraph 22 of the consent order. One email, unverifiable, no meeting minutes, no committee review, no second confirmation. The Americas Reputational Risk Committee, the body specifically tasked with reviewing high-risk client onboarding, did not convene. For the next 5 years, this single email would be cited again and again to clear compliance alerts. 2013, cited at onboarding. 2014, cited when the Butterfly Trust was opened. 2013 again, cited when a compliance officer flagged co-conspirator 2 as a trust beneficiary. 2015, cited during a press escalation review when new media coverage appeared. 4 documented instances across 5 years. Each time a compliance officer raised a flag, the response was the same. The approval email already cleared this. One unverified internal email became the institutional justification for half a decade of inaction. Source check. The consent order describes a single approval email cited at 5 points over 5 years. The pipeline searched for this phrase across the entire Deutsche Bank corpus. Approval email appears in 130 of 229,000 documents, 130 instances of a document referencing the email that cleared the Epstein relationship. But the broader pattern is more revealing. No rep, shorthand for no reputational risk review required, appears in 44,037 documents. The consent order describes one email. The corpus shows its echo. 44,000 records containing the phrase that meant, "Do not look further." The Butterfly Trust. Opened January 24th, 2014, 5 months after the relationship began. Checking and money market accounts. The KYC documentation, the Know Your Customer form that banks are required to complete, stated the purpose was to pay expenses and disbursements related to the trust. Taxes, trust fees. The beneficiaries were described as employees or friends. That is the language on the form, employees or friends. No names, no verification of the relationship between the trust and the people receiving its funds. Between 2014 and 2018, the Butterfly Trust generated more than 120 wire transfers, totaling $2.65 million. The recipients, women with Eastern European surnames. The stated purposes, hotel expenses, tuition, rent, immigration expenses. At least 18 of these wires, each $10,000 or more, went to 3 individuals designated in the consent order as co-conspirators. Co-conspirators 1 and 2 invoked the Fifth Amendment in prior legal proceedings. Co-conspirator 3 allegedly recruited underage victims for Epstein. These are the beneficiaries that the KYC form described as employees or friends. Hotel expenses, tuition, rent, immigration expenses. Those are the stated purposes on the wire transfer memos. The consent order identifies these categories in paragraph 31. The pipeline independently confirms a related data point. In the DOJ corpus wire transfer records, Ghislaine Maxwell appears as originator on 31 wires totaling $2.6 million. The consent order describes the trust's outflows. The corpus contains the underlying transaction records, 2 different data sources, overlapping findings. October 2013. A compliance officer flags co-conspirator 2 as an intended beneficiary of the Butterfly Trust, then in its onboarding phase, 3 months before the accounts formally opened. The compliance system works. The flag is raised. The response? Alert cleared. Justification? The approval email. The same email from May 5th, 5 months earlier, is cited to dismiss the alert. Co-conspirator 2 had invoked the Fifth Amendment in prior proceedings related to Epstein. The bank's compliance team flagged this individual, and the flag was cleared by citing an unverified internal email. March 2017. The transaction monitoring team flags payments to a Russian model and publicity agent. The flag is raised. The response? Alert dismissed. The documented justification, paragraph 41 of the consent order, reads, normal for this client. Normal for this client. Wire transfers from a convicted sex offender's trust to women at a Russian bank. Normal. May 2018. A compliance officer inquires about payments to women with Eastern European surnames at a Russian bank. Not a system-generated flag this time, a human asking a question. Accountant 1 replies, sent to a friend for tuition for school. Cleared without follow-up. No request for documentation. No verification of the school. No identification of the friend. The answer was accepted as given, and the inquiry was closed. This phrase, sent to a friend for tuition for school, appears in 11 documents in the corpus. Script 18 searched for 7 categories of compliance language across all 229,000 bank documents. The results. Halt inquiry language. No further action. 67,777 documents. No escalation. 12,326. Executive intervention language. As discussed. 57,300. Exception approved. 145. Exemption provided. 6,080. Compliance system vocabulary. Structuring. 81,000. Beneficial owner. 11,000. These are not findings. They are the linguistic landscape of a compliance system. Some of these phrases are routine. No further action in a bank processing millions of transactions may appear tens of thousands of times in the normal course of business. But the density of halt inquiry language, no further action in 67,000 documents, establishes the institutional context in which normal for this client was not an aberration, it was the default. Between 2013 and 2017, Attorney 1, Epstein's personal attorney, made 97 cash withdrawals from Deutsche Bank's Park Avenue branch. Each withdrawal, $7,500, exactly, the third-party cash disbursement limit. Frequency, 2 to 3 times per month. Total, more than $800,000. Stated purpose: travel, tipping, and expenses. 97 identical transactions at the exact threshold amount. The consent order identifies this pattern in paragraph 48. The visual speaks for itself. July 2017. Attorney 1 requests a withdrawal exceeding $10,000. A bank employee informs them that this amount would trigger a currency transaction report, a mandatory filing with the Financial Crimes Enforcement Network. Attorney 1's response: split the withdrawal over 2 consecutive days. The consent order documents this in paragraph 51. A bank client is told about a reporting threshold and immediately structures the transaction to avoid it. This is the textbook definition of structuring. It is a federal offense under 31 USC section 5324. 2018. The same individual, Attorney 1, withdraws $100,000 in a single cash transaction just before Deutsche Bank closes its Park Avenue branch. 97 withdrawals at $7,500, then one at $100,000. The consent order notes both facts in paragraph 52 without connecting them. The pattern is in the record. Pipeline stage. 2 scripts produce the analysis in this episode. Script 16, the bank document classifier. It took 229,000 raw documents and sorted them into 10 categories. Then it extracted wire transfer records, producing 224 clean wire records after validation. Script 18, institutional forensics. It searched for willful blindness language across the classified documents, 7 categories of compliance phrases, 72 individual phrase counts. It also mapped the ownership graph and constructed the compliance timeline. The pipeline processed the same documents that the NYDFS examiners reviewed. The NYDFS found compliance failures. The pipeline quantified the linguistic patterns underlying those failures. January 30th, 2015. In late 2014, the Anti-Financial Crime Department escalated concerns about the Epstein relationship. In January 2015, AML Officer 1 flagged new press developments. On January 22nd, 8 days before the committee meeting, Executive 1 and Relationship Manager 1 met Epstein at his New York residence. Executive 1 accepted Epstein's denials. On January 30th, the America's Reputational Risk Committee met. The outcome? Comfortable with things continuing. No minutes were taken. The consent order states this explicitly. Paragraph 37. No minutes taken at the committee meeting that decided to continue a relationship with a convicted sex offender. This was a violation of the bank's own policy. February 2015. The ARRC imposed 3 conditions on the Epstein relationship. 1. Existing trades could continue without pre-approval provided no unusual activity. 2. New accounts could open if already approved by wealth management. 3. The business must monitor for reputational developments. These conditions were never communicated, not to Relationship Manager 1, not to Relationship Manager 2, who replaced RM1 in April 2016 without being informed, not to the transaction monitoring team, the people whose job was to flag suspicious activity. The conditions existed on paper. The people responsible for enforcing them did not know they existed. AML Officer 2, a senior compliance officer, did receive some information about the ARRC conditions. Their interpretation? Instruct the monitoring team only to verify that women involved in transactions were at least 18 years old. That is paragraph 42. The ARRC imposed conditions about unusual activity, new accounts, and reputational monitoring. By the time those conditions reached the people enforcing them, they had been reduced to a single instruction: check the age. This is not a failure of technology. This is not a failure of information. This is a failure of institutional communication, where compliance governance degraded into a single data point that missed the point entirely. The full timeline: 2005, press allegations and the Palm Beach police investigation. 2007, guilty plea. 2009, the non-prosecution agreement made public. 2012, relationship manager 1 joins Deutsche Bank. 2013, the approval email. August, accounts opened. October, first compliance alert, cleared. 2014, Butterfly Trust opened. 2015, ARRC meets with no minutes, imposes conditions never communicated. 2016, new relationship manager, not informed. 2017, normal for this client, the structuring incident. 2018, tuition for school. November, the Miami Herald publishes. December 21st, Deutsche Bank terminates the relationship by letter. From the first press report to the last transaction, 13 years. From account opening to termination, 5 years and 4 months of documented compliance failures. The consent order names no individuals. It identifies 13 roles: Executive 1 and Executive 2, the co-head and COO of Wealth Management Americas, Relationship Manager 1 and 2, a Relationship Coordinator, a Coverage Team Member, 2 AML officers, an attorney, an accountant, and 3 co-conspirators. Each designation conceals a specific person who made specific decisions documented in the record. The approval email was sent by Executive 1. The 97 withdrawals were made by Attorney 1. The tuition for school explanation came from Accountant 1. The underage victim recruitment is attributed to co-conspirator 3. The names are withheld. The behavior is documented. The consent order provides enough context to narrow many of these designations. Executive 1 was co-head of Wealth Management Americas in 2013. That narrows the pool to a small number of individuals at a single institution in a single year. Relationship Manager 1 joined Deutsche Bank in November 2012 from an institution where they previously serviced Epstein. That narrows the pool to 1. Attorney 1 made 97 cash withdrawals from the Park Avenue branch between 2013 and 2017. These are not anonymous figures. They are identified by role, by timeline, and by action. The consent order tells you everything except the name. $150 million, paid by Deutsche Bank's shareholders. The consent order does not state whether any of the 13 designated individuals faced personal consequences. It does not say they were fired. It does not say they were disciplined. It does not say they were referred for prosecution. The penalty was assessed against the institution. The decisions were made by individuals. December 21st, 2018. Deutsche Bank terminates the Epstein relationship by letter. The trigger? The Miami Herald's investigation of the 2008 plea deal published the month before. After 5 years and 4 months of documented compliance failures, the relationship ends not because of internal review, but because of external journalism. Post-termination, Relationship Manager 2 drafts reference letters on Deutsche Bank letterhead for 2 other financial institutions. The consent order documents this in paragraph 54. The bank closed the account, and then the relationship manager helped the client find a new bank. Script 16 parsed the Deutsche Bank records in the DOJ corpus. 224 clean wire transfer records extracted. Date range: March 2014 through February 2019. Top originators by dollar volume. Southern Trust Company, $13.9 million in 3 wires. Ghislaine Maxwell, $2.6 million in 31 wires. Jeffrey Epstein, $2.3 million in 56 wires. Plan D LLC, $1 million in a single wire. DB Wealth Management, $737,000. Terramar Project, Ghislaine Maxwell's nonprofit ocean conservation organization, 45 wires totaling $201,000. The Butterfly Trust, 1 wire at $150,000 in these records. LSJ ELLC, $42,000. Every wire transfer in the extracted records routes through a single address. 575 Lexington Avenue, 4th floor, New York. HBRK Associates. The Office of DKI PLLC, Darren Indike's law firm. Indike is the co-executor of Epstein's estate and co-trustee of multiple Epstein-associated entities. His office is the common node, the hub through which funds flow to named beneficiaries. Those beneficiaries include Piazza, a French auction house, $699,000. Cabinet Alberto Pinto, $732,000. Seoul Auction, $564,000. The American University of Paris, $14,000. Warren Power and Machinery, $16,000. Art Auctions, Interior Design, Academic Institutions, Industrial Equipment, all routed through a single law office. Darren Indike and Richard Kahn, co-executors of the Epstein estate, officers or trustees of Southern Trust, LSJE, LLC, and other entities in the corporate structure. Both operate from 575 Lexington Avenue, the same office through which every wire in the extracted records was routed. The wire flow pattern shows Southern Trust Company receiving $13.9 million as a beneficiary and sending $13 million as an originator. Round-trip flows through the estate's corporate structure, with Indike and Kahn as the controlling individuals at every node. The ownership graph from Script 18 maps 33 entity relationships. The same 2 names appear at the nexus of every pathway. This thread continues in Episode 9, 53 Shells. Transparent Science. 2 disclosures. First, wire extraction false positives. Script 16's initial Swift and Fedwire tag matchers produced 356,000 matches. The :20 Swift reference tag matched random tabular data in OCR output. After validation, 224 clean records. That is a 99.94% false positive rate on the initial extraction. The difference between 356,000 and 224 is the difference between running a script and validating its output. Second, willful blindness phrase counts are not evidence of wrongdoing. No further action appears in 67,000 documents. As discussed appears in 57,000. These phrases are standard compliance vocabulary. A bank processing millions of transactions generates tens of thousands of documents containing routine compliance language. The pipeline counts the phrases. The analyst interprets them. The consent order, written by NYDFS examiners who reviewed these same records, provides the interpretive context. The pipeline's contribution is quantification, not accusation. Error log. Wire extraction. 356,000 initial matches reduced to 224 clean records. 430 blank templates suppressed. Date range is partial. Not all wire transfers in the original records were successfully extracted by OCR. Handwritten fields on KYC forms remain largely unreadable by machine. Bank document classification. 21,000 documents classified as Other. The unclassified residual that didn't match any of the 9 defined types. Willful blindness phrase counts. No further action. As discussed, and structuring are standard compliance and business vocabulary. Their frequency alone is not diagnostic of wrongdoing. And a final note, the consent order is a regulatory settlement, not a judicial finding. The $150 million penalty was agreed to, not adjudicated at trial. No contested factual determination was made. One email, 5 years. $150 million. The consent order does not allege that Deutsche Bank helped commit crimes. It alleges something more precise, that the bank chose not to look. 97 cash withdrawals at exactly $7,500. More than 120 wire transfers to women with Eastern European surnames dismissed as normal for this client. 13 individuals identified only by role. The penalty paid by shareholders. Next episode, the SAR. $47.3 million in suspicious activity. TD Bank. FinCEN Suspicious Activity Report, filed October 1st, 2019. 25 named subjects. Wire memos that read, Close DB account. The money trail continues from where Deutsche Bank's compliance ended.